Real danger is we are in the largest credit bubble in history. Is the other side of debt is credit. Debt equals credit. So if we're in the largest debt bubble in history, we are in the largest credit bubble in history. Credit bubbles tend to pop. They always do eventually. And that's what we're seeing today. The point to understand is that we have a combination of the largest credit bubble in history going pop and Smoot-Hawley Tariff Act Mark II, courtesy of President Trump, at the same time. Exactly the same dynamics, but worse than we saw between 1929 and 1930.
In recent weeks, financial markets have become increasingly unsettled. Stock prices have swung sharply, investor confidence has weakened, and signs of stress are beginning to show in both bond markets and global trade. One of the key reasons behind this renewed uncertainty is the growing talk of new tariffs and trade restrictions, especially between the United States and its major trading partners. Concerns are rising that these trade tensions could do more than just raise prices. They could slow down global economic growth, disrupt supply chains, and push highly indebted economies closer to crisis. To better understand the deeper risks behind these headlines, we turn to veteran economist and precious metals analyst Alasdair Macleod. In a recent interview with Natural Resource Stocks, Macleod explains why he believes we are now at the edge of the largest credit bubble in modern history. He points out that today's global debt levels, across governments, businesses, and households, are higher than ever before. And because debt and credit are two sides of the same coin, he argues that what we're really facing is a massive credit bubble that is now starting to burst. But that's not all. Macleod draws attention to a dangerous pattern we've seen before in history. In the late 1920s, a similar credit boom ended with a major crash on Wall Street. Around the same time, U.S. lawmakers passed the Smoot-Hawley Tariff Act, which raised taxes on imported goods. That move triggered a wave of retaliation from other countries and made the Great Depression even worse. Today, we are seeing a similar combination. A fragile financial system built on easy credit and growing pressure to impose tariffs that could shrink global trade. And unlike the 1920s, today's world is even more connected, meaning the consequences could be larger and faster moving. As we present clips from Macleod's interview, please watch, like, and share this video, subscribe to the channel, and turn on the notifications bell for more videos like this. We appreciate the support and hope you enjoy the video.
I've been writing for some time that the real danger is we are in the largest credit bubble in history. And if you don't believe it, just look at the debt. Ask yourself, are we in the largest debt bubble in history? And I think undoubtedly you will tell yourself, yes, we are. The point about debt is the other side of debt is credit. Debt equals credit. So if we're in the largest debt bubble in history, we are in the largest credit bubble in history. Credit bubbles tend to pop. They always do eventually. And that's what we're seeing today. On top of that, we have tariffs. The tariff agenda is lethal as far as the credit bubble is concerned. It is exactly the same dynamic that we had in 1929 to 1930 when we had the popping of the Roaring Twenties credit bubble. We had the Fed, it was the first decade of the Fed with Benjamin Strong. And he believed in if you like, credit expansion to drive the economy. On top of that, we had the Smoot-Hawley Tariff Act, which increased tariffs by an average of about 20% or slightly more. Now, in those days, I understand that consumer goods imported from abroad accounted for no more than 2 or 3 or 4% of total GDP. This time it is different. It is considerably more. The consequences of Smoot-Hawley Tariff Act Mark II are considerably greater than first time round. Not just because of the increased volume, if you like, of imported goods into America. Also, we have supply chains across the world which are affected by this. We also suspect, and the rhetoric has very much confirmed this, that other countries will respond with tariffs of their own. So we have this situation. I have no doubt at all that the EU will do just that. The UK is sitting on its hands trying to pretend that there is a special relationship. We have been treated better by Trump with 10% tariffs as opposed to the EU, which is, I think, 20% tariffs. And consequently, we just don't want to shout about our position too much because we don't want to upset President Trump. So, but going back to the point, the combination of a credit bubble bursting and tariffs on top were what drove Wall Street down from the highs in September 29 to the lows in 1932. And on top of that, we had about 9,000 banks going bust over that time and following that time. And, people say, well, the problem with the reason we had a depression was because of the contraction of money supply. What they failed to understand is the reason that money supply contracted was because banks went bust. It's the only way in which bank credit gets removed, if you like, from the economy, by banks going bust, or alternatively, people who owe debt to the banks going bust. Then it gets wiped out. It's as simple as that. But until then, what happens, and particularly since we don't have a gold standard of any sort, is that credit just gets passed on. But that's a slightly separate, I'm going off topic going in there. But the point to understand is that we have the combination of the largest credit bubble in history going pop and Smoot-Hawley Tariff Act Mark II, courtesy of President Trump, at the same time. Exactly the same dynamics, but worse than we saw between 1929 and 1930.
Alasdair Macleod's analysis paints a clear picture. We are not simply facing ordinary market turbulence, but the early signs of a much deeper crisis. The warning signs are all around us: ballooning government deficits, corporate balance sheets weighed down by leverage, and consumers increasingly dependent on credit just to stay afloat. His comparison to the 1929 crash isn't just a historical footnote. It's a reminder of how fragile financial systems become when debt grows faster than the real economy. And just like in the late 1920s, rising trade barriers today are making a bad situation worse. Back then, the world was still adjusting to central banking and the illusion of endless credit growth. Today, we've gone even further. Central banks have spent years propping up the markets with near-zero interest rates and quantitative easing. But what happens when these tools no longer work? What happens when confidence breaks? We're already seeing cracks appear. Credit conditions are tightening. Banks are becoming more cautious. And despite official reassurances, inflation remains a persistent threat in many economies, forcing central banks into a difficult balancing act. The big question now is, can this system hold together? Or are we heading toward a reset, one that may look very different from the slow recoveries we've seen in the past? As we continue, we'll explore some of the deeper structural issues behind this instability and what it could mean for markets, currencies, and everyday financial life in the months ahead.
Of course, talking about real estate, I mentioned commercial real estate. The interesting situation is what's going to happen to the residential property market. And, there you're going to see mortgage rates rise and people will not be able to afford their mortgages. And not only that, but unemployment will be increasing. This is a hell. This is absolute hell. The political imperative is that the Fed, the US Treasury, and so on, and of course their opposite numbers in other countries, can't just stand there and watch this happening. They're going to have to intervene. And intervene they will. They will do what they can to, stop all that's going to happen. And all it'll do is just undermine the currencies even further. I'm afraid. What they used to do before 1929 to 1937, 8, whatever, was government took the view that, when you had this sort of credit cycle going pop, don't get involved, stay away from it. And for example, the depression. I mean, it was very sharp and very nasty. Lasted 15 months because government knew, don't get involved. Let them, just let people sort themselves out. And, so what happened was that capital got redeployed from things that were going bust into things which were, might do well in the future. But the only people who could take those decisions were entrepreneurs who knew what the hell they were doing, not government ministers. And of course, he then became president following Coolidge, and it was a disaster. Then you had Roosevelt following him, and Roosevelt was doing exactly the same thing, sticking his nose into every bit of business, the New Deal and all the rest of it. He was just doing exactly what Hoover had been doing before. So ever since that, you've had this government intervention. The government knows best. The government has this political imperative to make sure that nobody gets hurt, that make sure that, and of course, this is now sort of morphed into, we need to ensure that prices continue rising at the rate of 2% so that consumers are encouraged to consume rather than save. I mean, come on. I mean, we have got a hell of a mess to sort out now. And this is, if you like, it is a 1 centuries old mess that's coming up to be sorted out. I mean, literally, this is potentially horrendous. I think anything they do will probably make it worse or prolong it. And worse than that, I can't see that anyone in government has the first inkling, if you like, of basic economics. They think in Keynesian terms, they think in macroeconomic terms, which is complete non-science. It's a socialist ideal, if you like. We can manage markets. No, you can't. And I'm afraid that the time has come for us to pay for all these follies.
You would say gold is sniffing all of this out?
Yeah. I mean, it's going back to central banks. I mean, what central banks are doing is not so much buying gold as dumping fiat currencies. That is the adjustment they're doing in their reserves. I understand. You've got to look at it from their point of view. Their point of view is actually quite simple. We're holding dollars. Dollars are going down. We don't want dollars. What do you buy? Euros? No. We've got some of those. Sterling? No. Yen? No. We don't want to buy any of those. We've got them. Basically, we see risk in the dollar-based fiat currency system. So we've got to hedge that risk by selling them and moving into real legal money, which is metallic with no counterparty risk, and that's gold. So that's really what they've been doing. And I think it's a process that will continue. And I think the thing to understand about gold is its purchasing power obviously fluctuates, but it doesn't fluctuate by very much. Certainly not as much as the purchasing power of a fiat currency. And if you look at prices, say 2,000 years ago, for many of the common goods that we need, as humans, you'll find that the prices in gold are actually quite similar to the prices today. So, this is, if you like, I'm not saying that gold is a sort of wonderful, beautiful, and it's absolutely steady and there's no variation in its purchasing power whatsoever. But what I'm saying is that taking everything into consideration, it maintains its purchasing power over a long period of time. And if you look at estimates of above ground gold stock and how that has been increasing, it increases at roughly the same rate as the world population. So in other words, the human users of gold, not that they use gold, so we can come on to that in a second. The human users of gold basically find that gold is expanding at the same. What do we do with gold? I mean, we have gold coins, maybe we might even have bullion. But if you look at in terms of coinage, then gold coins and silver coins are not the thing you use first to pay for goods and services. No, it's the last thing. Gresham's law basically says that the bad money drives out the good. What's happening is that you spend the credit, if you like, which even on a gold standard is based on gold. It's linked to gold. And if you're worried about the value of that credit, then you encash it for gold coin. That's the way a gold standard works.
Alasdair Macleod has laid out a compelling case, one that connects historical precedent with today's market signals. At the core of his message is this: we are living through the late stages of an unprecedented global credit expansion, one that, like all credit bubbles before it, is approaching its breaking point. The signs are becoming difficult to ignore. Across the financial system, leverage is maxed out. Household debt in many developed economies has returned to pre-2008 levels. Commercial real estate is under immense pressure, with rising vacancy rates and falling valuations. Residential housing markets, propped up for years by artificially low interest rates, are now beginning to show cracks as mortgage costs soar and buyers step back. Central banks, having hiked rates to combat inflation, now find themselves caught between fighting price instability. At the same time, global trade tensions are escalating. We are seeing the return of tariffs and protectionist policies, echoing the conditions that deepened the Great Depression nearly a century ago. As Macleod reminds us, it's not just the volume of imported goods that matters now. It's the interconnected nature of today's global supply chains. When tariffs hit, they ripple through industries, triggering cost pressures, layoffs, and supply shortages on a global scale. In response, governments and central banks are once again stepping in, not to let markets correct, but to intervene, control, and delay the pain. Their tools are familiar: fiscal bailouts, foreclosure freezes, and monetary easing in new forms. But as Alasdair notes, these solutions only serve to deepen the structural imbalances and undermine the credibility of fiat currencies. And it's in this context that gold, so often dismissed in recent decades, has returned to the spotlight. Not because it promises profits, but because it preserves value. Central banks are not merely buying gold. They are actively shedding exposure to fiat currencies like the dollar. What we're witnessing is a quiet but deliberate reallocation away from political money toward monetary assets with no counterparty risk. Why? Because gold doesn't depend on promises. It isn't backed by policy. It's backed by time-tested economic reality. Over centuries, its purchasing power has remained remarkably steady, even as empires, currencies, and central banks have risen and fallen. So, where does this leave us? It leaves us at a turning point. The financial system we've relied on is strained by unsustainable debt, misguided intervention, and declining trust. And while the collapse of confidence may not happen overnight, the underlying trend is clear. The rules are changing. In the months and years ahead, those who understand this shift will be best positioned to protect their savings, rethink their investments, and adapt to a more uncertain world. If you found value in this analysis, please like, share, and subscribe. Let's keep the conversation going, because understanding what's ahead is the first step to navigating it. Thanks for watching, and see you in the next one.